Thank you. Hello, everybody. Thank you for having me back, of course. And I'm going to be talking to you about swing trading and day trading. You can do both. You can choose to do one or the other. I enjoy doing both. No reason to restrict. You have to use same strategies, different time frames is the only thing that's necessary. A little bit about myself. I've been doing this a long time. I started out like many of you, probably worse off than many than you because there was no internet. There are pluses and minuses to that. Well, there wasn't a lot of information out there. I wasn't inundated with an overwhelming amount of information. Pluses and minuses. It was very difficult to find ways of learning. There were books. There were letters that came via snail mail, and so on. So it was a long journey, a lot of it trial and error. So back in 1994, I started a company. Some of you may have heard about it. You can see the names here on the books, pristine. I eventually sold all that, the old recordings. They were very outdated. I was happy to sell them back in 2015. But when I started, I used to send out fax letters. Used to come on that thermal paper. Then we had a phone hotline. Used to call an 800 number. So I've been in the advisory part for a long time. The education part, did hotel seminars, and even owned a brokerage firm. Master Trader was a brokerage firm. So I was there on the cutting edge of what has developed over these years, and eventually, through education, through the evolution of the internet, um, you know, all of those big brokerage firms that said stay away from day trading began to buy up all of the firms, and eventually sold the brokerage firm. And so that's a lot of history. I used to do live trading challenges, taught a lot of people, hedge fund managers, specialists, learned that most of them don't know a darn thing about technical analysis. Of course, why they paid for the education, good for them. Prop traders, retailers, investors, some of my students you'll find there. And I'm proud of them. They learned, they out there, some of them work for other education companies, some of them started out on their own, some of them are money managers. It's a testament to the education that I've provided in all of those years. This is me, guy in the middle there, 1999. All right, remember 1999? Internet stocks, none of them made money, but they were going through the roof. What a time. So this was the Traders Expo. Today, those Traders Expos are kind of software presentations and brokerage firms. I don't know how much education there are, but used to go to those years ago and do trading challenges. They were a lot of fun. You can see the logo for the old company, Pristine. The brokerage firm, that was the Master Trader. And the lower right there is the Master Trader today, educating master traders and investors. And so that background there was these giant booths that we used to have delivered to these events. And that was it. Training, trading, and technology. The 3 T's is what we called it. So they were great events. They were lots of fun, but it's the past. So this is the essence of where I have developed and educate from, is that all of these individual concepts build on each other to create strategies. So any of them by themselves aren't a strategy, meaning, so yeah, we can trade prices, but what do they look like? Well, candlestick format. Why? Because they create pictures. Void. Well, this is another conversation, but it's just in the essence of there's no support or resistance, new all-time highs. Is the trend up, down, or sideways? Multiple time frame analysis, support, resistance, relative strength, weakness, volume. And when I say it's secondary, many make a big deal out of volume. For me, it's not a big deal. Why? Because at the time of the trade, which is dependent on price action, I'm going to be part of the volume. Right? I'm not going to be looking for volume confirmation. Right? And there's too much to pay attention to with price for me to pay attention to volume. With volume, all I want to know is that there's adequate volume, that there's liquidity there. That's all, right? And in hindsight, you can see there were big volume spikes on maybe big down moves, and then they went up. But at the moment of the trade, I don't care about volume other than there's enough liquidity there. What's the broader markets doing? Market internals, right? What are market internals? Breadth, sentiment, intermarket analysis. I'm going to trade oil stocks. Maybe what the price of crude oil is doing would be an advantage to know. Know that type of thing. Position and money management. Without that, you'll never make it. Right? You know how to have to manage positions. You know how to have to manage the money. And I always ask, would you go into business without a management plan? And everybody says, hell no. Well, why do the majorities do it when it comes to the stock market? And they do. It's kind of quiet as to get an answer. It's because of fear and greed. And most of us, if not all of us, come to the markets from another position, entity, business. And so we're in a rush to get into it. And we don't take the time. And money management is the last thing you want to learn about because you're focused on the candlesticks, which without the money management, you're not going to last. And that's directly traded to your psychology, right? Trader psychology and money management are intertwined tightly together. Right? Put on too big of a position, you can't think straight. It's just the way it is. One concept is not a strategy. We have to put them together, and that's what we're going to do. Right? Everybody's hurt. You need confidence in what you're doing. You can't do anything, not just trading, without confidence. Trading, you need patience because sometimes it takes a bit of time for things to set up, and you need the discipline. How do you do that? Well, I can only tell you how I do it. Right? I have to reduce the subjective analysis or eliminate it. What does that mean? No indicators. Take them off the chart. Analysis paralysis, combinations of indicators, which settings. It's just what I like to call brain damage. Got rid of that many years ago. Systematic, objective method. I'll explain it to you. This builds a thought process. As you're in front of your screen, you're thinking. What are you thinking about? Is it going up? Is it going down? How do you define that? Is it going sideways? Should I sit on my hands? Should I buy? Should I sell? You have to put together a thought process that will build confidence as you get experience. So we need to remove the mystery from technical analysis and build that thought process. What type of trading will you do? Swing trading, day trading? You can do both. You can't mix them, right? Because it gets confusing. Day trading setup, daily, weekly charts, right? There you go. Day trading, what time frame are you going to use? There's lots of different time frames. I'll cover you how I do it. So we need to define the trend, right? What is it in the time frame being viewed? This can become confusing until you have a method of doing it, meaning you could have a daily time frame going up, an hourly time frame going up, a 15 and 5 going down. How do you combine those things? Right? How do you define trend changes? Define support and resistance, or the lack thereof, that it's not there. Right? Support I interchange with demand. Why? Because at that support, people are going to take positions. They're going to buy, and they're going to sell at resistance. So there's supply there. So we have to define that, where those buyers and sellers are going to be. That's building the thought process. The void concept means, well, if it's new all-time highs, there's nothing there for you to trade against to put out an offer. And so that's a great thing. Prices gap down like they did this morning. They gap down where a seller's going to be. So if you're a gap trader, that's going to be when they fill the gap or they come into a base that they broke down from. So we have to define the time frames that we're trading. We have to define our position in money management for the time frames that we're trading. And then we need to have the ability to follow the plan. And if you've been doing this for a while, you know exactly what I mean. Right? Some of you have written out plans extensively. You get in front of the screen, goes out the window. It's part of the process. Eventually you get burned up a little bit and you'll start following the plan or you'll lose all your money. Right? So I like this saying that I made up years ago. Technical analysis are pictures of others' beliefs and expectations created with money. And that really brings home what's going on in the chart. It's not about the stochastics. It's not about the dark cloud covers and all of those words, fancy words that are used. It's about what other people are doing with their money and what kind of pictures does that create on a chart. And so we're price pattern traders. Those patterns communicate to us how other traders have acted and what their beliefs are. What are their expectations? That's what's displayed on the chart for us to see. There's nothing hidden about it. Now, we have to put together these concepts for a plan that put the odds in our favor. Right? Are multiple time frames aligned in the same trend or not? Are they opposing? So there's different probabilities as to chart setups and patterns and what's in alignment or the lack thereof. But when I look at these candles, right, I coined this term candle language because they speak to me. Right? When I look at that and I see what I'll call a bottoming tail candle, it went down and it went up. So there were buyers on the dip. That's a fact. Now, is it in an uptrend? Is it in a downtrend? Is it at support? Is it resistance? All of those things make a difference in the probability of that particular candle having real value to me, or whether is it just noise. We have to define our swing trading and our day trading. Swing trading, what is it? 2 to 10 days. Right? I'm not in here. I'm not investing. I'm not looking to hold on to this thing, for the next Amazon or Nvidia. Not that any of us wouldn't love to be holding on to one of those over the next 10 years and see, that's $2 stock go to 1,000, but that's not going to happen too often. Right? Anyway, we have to define what it is that we're looking to do. 2 to 10 days. That's it. Define the time frames. Day trading, 60-minute chart. Let's call it a macro time frame, 5-minute chart, or micro time frame. You might say, what about a 2-minute chart? Well, you could use a 2-minute or 1 minute. There's so many people out there now that are trading, micro e-minis, and they're touting looking at 15-second charts, which is crazy, to each his own. But the smaller the time frames you get into, the more you're getting closer to the noise, and the greater the probability you're going to get sliced up. 2-minute during momentum moves, especially first thing in the morning or during fast moves, I can use the 2-minute chart. Other than that, I'm going to be on the 5 and looking at what's happening on the higher time frames. Right? The analysis is all the same. Just because we change time frames, the analysis doesn't change. Is it going up, down, or sideways? Where's support? Where's resistance as it relates to the time frames that I'm utilizing? Let's just call it my world as an intraday trader using the 60 and the 5-minute and sometimes the 2. The other world, swing trading using the daily and the weekly time frame. No indicators, no proprietary systems. Everything I'm showing you, you can use in any software that you're utilizing. There isn't any best time frame. It's a choice. So you have to make that choice. You might hear someone might say, this is something I heard years ago. Someone said, Greg, I'm going to use the 4-minute time frame because I'm going to be ahead of you that you're using the 5. It's like, go ahead. Doesn't matter. Just be consistent in what you're doing. So this line chart gives you an overview of the thought process from the macro and the micro time frames. So the macro time frame is just the light blue line. And that's primarily what we're interested in. Is it sloped up? Is it sloped down? Is it whipping back and forth like an EKG, where it's just support and resistance back and forth? I need to know what I'm dealing with. And the micro time frame is going to ebb up and down as traders ride it up. They'll take profits, ride it back down towards support and back and back and forth until at some point that's going to end. So as it says, I'm going to look for, scan for retracements and breakout patterns and prices near the 20 MA. Why the 20 MA? Well, I've used it for almost 30 years. It works pretty good. Simple format, nothing exponential or weighted or any of that. Prices are near the 20. Ideally, it's really, is it near some price support and the 20, which would be great. Swing traders, weekly, daily time frame. Day trader, 60, 15, 5. I'm going to show you how I use them every day. Now, as it says, day trading requires focus. One of the hurdles, things that we all mess up as day traders, is looking at too much. Too much information. And I know from my own perspective, I have to focus. I can't look at too many things at once, maybe 3 or 4 different, indices or stocks, and focus on them. If I look at too much, I'm going to miss opportunities. And, we all have said, oh, I looked at XYZ and look what it did now. But I wasn't watching it at the time. Yeah, because you didn't focus, right? Or some news went by and, you're running around too much, right? Candlesticks simplified. Are they big bars? Are they little bars? They got tails on them. Are the tails on the top? There's tails on the bottom. Are they narrow range bars? Big bars or power bars? How big is the bar, Greg? Is however big it is compared to the stock you're looking at and what preceded it. It'll jump out at you. Big green bar next to little bars, that's a power bar. Big red bar, bearish. Plain and simple. Narrow bar, momentum is slowing down. Tail bars, topping tail bars, I say sellers took control. It went up and it went back down again. It was a big, and if you have tail bars that are narrow bars, but what we're interested in primarily are the big bars, what I'll call range expansion bars, because those are the ones that display emotion, commitment, on some levels failure, and present us the best opportunities. So these ranges, they contract and they expand and they form patterns. We're price pattern traders. There's a big hype about candlesticks out there. Right? And you can see the different names, engulfings and dark cloud covers and tweezers and so on. Look, as you change time frames, the picture is going to change. It's about retracements. So one candle can be a bottoming tail bar. 2 candles can look like a red bar and a green bar. A 3 candle, if that's called a morning star or a morning doji, who cares? What it really is just the transition at the bottom of the bottoming tail bar, or the transition from the red bar into the green bar. As you expand the data, you see more candles. It's not about the names. And so that's what I say. Forget the names and that hype. Think like a master trader. Understand that it's about these retracements. Names are irrelevant. If something spiked down and it went back up again, there were buyers down below. And then it went up. Now, where's support? Where's resistance? And so on, as you put it all together. These are 4 foundational patterns, right? Pullback patterns, retracements. Everybody trades those. Is it an uptrend? Is it a downtrend? Right? Dan and I just did an MT Live on bottoming stocks, and W patterns are a big part of what we like to find, because they have time corrections. So these sideways movements, the second row there, where it comes down and reverses and then it retests it. Those retest patterns create larger areas of support or resistance. And if you're doing a counter trend trade, they're definitely much more reliable. Right? So as a counter trend trade, like what we call climactic buys and sells, especially if they're narrow range bars, I'm not doing them. If there's big range expansion bars and it's a bottoming tail bar, I'll look. But there's a tendency to get out relatively quick because it's a counter trend trade. If you get a retest pattern and it builds a larger area of support or resistance, it's going to have a greater odds of making a bigger move. It's really just common sense. Flag patterns are patterns in where you had either a bullish or bearish move, and that's the spike up or the spike down, and then it just kind of drifts its way against that. So it's just more bearish or bullish confirming pattern. And then basing patterns, right, where they consolidate and build support. And you can see I've got red and green candles. And one of the concepts is if something is bottoming, that the red candles don't continue to break down. Now, this is one of my favorites, right? Money bars. Why are they money bars? Well, because they rarely fail. And they're preceded by power bars, wide range bars. So you see the plus WRB marked on there. Right? That's your power bar. And so from there, you've got information that suggests prices are going to move in one direction. Then prices often stall. It's just something that historically happens where you get that wide range bar and then you get that consolidation. It doesn't always happen. But if I can find something that initially started to move, so the one on the left there, it started to move and it continued to go up, and then it formed this where the star is, that bottoming tail bar. It's got the tail on the bottom. And notice how it broke under the lows of the prior two bars. There was a little shake out there where on a short time frame, and we're not even looking at time frame yet, but on a shorter time frame, it broke down under a base and it sprung back up again. That's the tell. That's the bar that tells me that there's demand, there's buyers lurking below. The one on the right, you got a wide range bar, an inside bar, and I call it a 1, 2, 3, 4. So it broke below the inside bar's low and it springs back up again. Again, it's telling me that there are buyers lurking below. And it suggests to me that prices are going to go up because those buyers are not going to be able to buy the dip. And as it starts to move up, they're going to become more aggressive and take the offer. And so I'm always looking for those kind of bars. For swing trades, right, you've all heard the idea, what was resistance becomes support and vice versa. Okay, how do we utilize that? Really simple. So we start on the left and start moving up toward the right. As prices break out above resistance, we look to that to be support. As prices pull back into that area, we then start looking at the candles that begin to form. Do red bars not follow through? Is it followed by a green bar? Does it have a bottoming tail bar? As we move further to the right, where it says major price support, MS, there's a green candle there. And let me just get this right here. It gaps down into this support area and it springs back up again. That's a tell. That tells me that there's buyers lurking below. Why? Because that's where there's support. Right? And so when it comes down there, I'm anticipating that. I'm not doing anything. I'm waiting to see if they show up again. And once it forms that pattern, at that point, it's like, go long. If you are an option trader, you could buy calls. If you like doing credit spreads, if there's premium, you can do a put spread. So there's a lot of different instruments to be able to profit. So you choose which one you like to use. I'm primarily a directional trader, right? Because you can make bigger money with directional trades. Sometimes you don't have lots of directional trades in a choppy market. But that's developing right now. Assuming whatever the president's going to say tonight, looks like we're going to have a lot of long directional trades. Things are setting up that way. So let's talk about multiple time frames. Right? We want them to be aligned. We want to, again, make it simple. Right? The alignment of them will put the odds in our favor. So if you want to hold, as it says, XYZ for days, weeks, or months, don't bother looking at the 5-minute chart, because you're going to see these topping tail candles. You're going to see these retracements on the 5-minute chart that are going to scare you to death, But on the daily time frame, they're going to be meaningless. So why look there? Because it's going to have an influence on you. Right? It's just the way it is. It doesn't give you any advantage. If you're a day trader, what are you going to look at the monthly? What am I going to look at the weekly for? I'm not interested in that. So I'm going to show you a way of using moving averages as a visual aid. Right? Why do I need a visual aid? Speeds up the analysis for me, because you'll get it as I explain it. I'm going to use simple moving averages. Right? They work. Stocks, indices, simple. You trade Forex, maybe you want to use exponential. I don't trade Forex. Right? They're not actual support or resistance. You'll have people saying the 200-day moving average is support. Believe me, you will see many a times where prices are going to slice through that moving average like it's not there, and you'll go, what the hell? Well, it's not support. It's not resistance. It could become a self-fulfilling prophecy because so many are looking at it. And the same with the 50. But we're going to use those moving averages. Right? That's why I'm going to use them. I'm going to follow what institutions are using. And after doing this as many years as I am, I'm convinced that those are the ones to use, right? On the daily chart. 20, 50, 200. Right? So we can determine the trends in multiple time frames with those moving averages. I'll show you how. How do you do that? So we're going to look at those moving averages, and I'm going to see where they are in one time frame, and I'm going to know what's going on in the other time frames. So to do that, you're going to calculate the number of bars in a lower time frame that make up a higher time frame, and then multiply that number by the moving average in the higher. That's going to give you your moving average in the lower time frame to tell you what's going on. Maybe those words sound complicated, but it's not. I call them smart moving averages because they're not arbitrary. They're useful to me in a smart way. So on my 5-minute chart, on the 60-minute, if I put a 20 MA, it's the same as a 240 on the 5. 12 bars times 20 equals 240. I'm just going to round it out to a 200 on the 5-minute. Weekly 10 MA, same as the 50 MA on the daily. 5 bars times 10 equals 50. See how simple it is? Right? 15-minute chart with a 20 MA. Same as the 60 on the 5. 3 bars times 20 equals 60. Nothing special about it. It just tells me on my 5-minute chart where the 20 is on the 15. So I'm going to put those 3 moving averages on my 5-minute chart. And now I'm going to know the trend, looking at my 5-minute chart, what's going on the 15 and the 60. Now on the daily time frame, which I'm interested in swing trading, I'm going to use what I said, the 20, the 50, and the 200. So if the 20 is the blue line, right? The green line is the 50, same as the 10 on the weekly. If the 20 is above the 50 and they're both rising, that means the daily time frame is going up and the weekly time frame is going up. Right? Simple. The 200 equal to the 10 on the monthly, it's sloped down, which means this stock whatever it is that we're looking at on this chart has gone through a correction and it started a new uptrend because the 200 is pointing down, but now prices are above it and the 20 and the 50 are above it. Now, what does the price action tell me? Well, you can see it says it's going up. I can be aware of what's happening in multiple time frames. And you can see the chart is moving higher on the daily. The weekly is moving up. The monthly is making a turn. So I want to be a buyer. Right? It's moving up. Buy pullbacks, buy breakouts, buy, this is what I call a shakeout pattern. Get the spotlight here, this thing here. So this is a power move up. It breaks down. There's support. It comes back up and it goes sideways. Price action sideways at resistance is bullish. Look at the bottoming tail bar right there. There were buyers on the dip. That's the tell. That's your clue. And it doesn't mean it was going to gap up, but it's telling me that buyers have control. This is be a minimalist. Right? Get rid of the indicators and the trend lines and the fib lines and the VWAPs. And if you're into Elliott Wave and Gann, I feel for you. You're in a bad place. Right? You're really into the deep end there. So on this example, we had a downtrend, the 20 is under the 50, and prices move up. These dots are nothing proprietary. They're the way we follow the trend. And in some platforms, they're called pivots. In some platforms, they have a fancy name called fractals. It's just a bar with 3 lower highs to the left and right, or 3 higher lows to the left and right. And whatever it called it in your platform, just set it to 3, and it'll look just like this. Exactly. 2 is, for me, was too tight. 4 was too big. 3 works just perfectly. So breakout, it's above the moving averages, 20 above the 50, 200 sloped up, think long. Be buyers on pullbacks, big moves up, sell credit spreads, do longs, buy calls. Our focus here is determine what's the direction, and then from there, we'll apply the candlestick analysis, support and resistance to determine what vehicle we want to use to make money from it. Options, buy the underlying, credit spreads, debit spreads, there's lots of different ways. Support, resistance. So some institutions, they buy at the 50 and the 200. That enables us to know part of the thought process, what's going on there. I see pullbacks to support, the little green box there. I'm getting ready. Even though it's rolled over a little bit, it's under the 220, that's okay. It's coming down to support. The trends are up, right? All MAs are sloped up. I'm only thinking long. I'm not thinking short. Day trades, 5-minute chart, 20, 60, 200. Same process of thinking, different time frames. This is what I do in the green room, right? It's 5-minute chart trader. Right? In the afternoon, you could use a 15, but primarily it's the 5-minute chart as explained previously, and why I'm using those moving averages. That link on the top, if you're interested in the green room, that's 2 months for the price of one. So we're aware of what's happening in multiple time frames. I showed you how to calculate them. I put them on my chart just like that. And these 2 lines that are here, this is part of my thought process. The red line is the prior day's close. The blue line is the day's open. If prices are above those 2, the daily candle body is green. And if those moving averages are pointing up, the power is on the upside. Okay. All right, let's continue. There's an example, 5-minute chart, breakout failure, that topping tail bar right there, BOF is breakdown failure. This is what I'd be looking at in the green room. Moving averages are pointing down. Think short. Right? Simple. You got multiple time frames in alignment. Now, this thing kind of extended, this example. So over here, it starts chopping sideways and breaks down. You see extended from the moving average. So I don't use oscillators. I don't use words like overbought or oversold. I look at prices that are extended. And when they're extended and they break support, then I start thinking short. I start thinking call spreads. If this was SPX, I'm thinking 0 DTE, credit spreads, call spreads. So lots of different ways for profiting. Here's an example intraday with pre-market data. Prices were going down, shoulder, head, shoulder, same thing. Wide range bar. There's your correction bar, money bar on a smaller time frame. It tells me think long. It's not complicated. We just got to put together the thought process. This is intraday time frame, and I'm going to be a buyer after the setup. Right? So if the daily time frame was up, the analysis would be the same. If this is part of what's happening right now on daily time frames that we covered in MT Live today. This now the right side of the chart isn't happening just yet, but these bottoming action is what's happening right now. So the analysis is the same. We're just changing time frames. This is scanning software that I use, TC2000. I have no affiliation whatsoever. I'm just showing to you how I find opportunities. Top-down approach, just looking at sectors and ETFs and stocks within it. Apply the same thing. If you become a member of Master Trader and you use this platform, I'm happy to share my layouts and scans with you, which are extensive and extremely well done, if I don't say so myself, because I created them. MT Live every Wednesday, just did this at 12 o'clock, 12 to 1. Every day at 9 o'clock, Dan and I are live on YouTube, Facebook, X, probably somewhere else too. It's being streamed. You can check it out on YouTube/C Master Trader. If you want replays and live reviews from letters that are being reviewed with multiple time frames and money management, go to that mastertrader.com/advantage. And here is my offer for today. And I've never done this before with these courses. But if you go to mastertrader.com, trading skills 50 with the caps just like that, it'll bring you to this page. And if you use that coupon code, which I've extended this week because I was doing the presentation today, and use March 2025, there's 6 courses there. If you're an option trader, if you're a swing trader, if you're a gap trader, if you want to learn about money management, just use that coupon code at the checkout and it will reduce the price by 50%. It's a phenomenal offer. And if you have questions on that, I think I'm at my end of my time. I think I got 2 minutes left. I don't know if there's any questions. You guys and ladies are very quiet. I know I'm talking pretty fast because this is a bit of a sprint to do this, but I'm always available via email, greg@mastertrader.com. Even if you're not a member, I'm happy to answer your emails. I will be live tomorrow morning on YouTube and Facebook and Twitter at 9 o'clock, explaining what's happening in the markets. It should be exciting after today's tariff news. And so as the bearishness of what was unfolding prior to the last 3 days, you hear how I explain what was happening each morning and how things developed toward a more neutral to somewhat bullish bias. Now, whatever he says tonight could throw a monkey wrench on the whole thing. I don't know, but right now things look pretty darn good, like they're going to go up. But if I knew for sure, I wouldn't need a stop loss. And so we'll see what transpires tonight. But no matter what happens, with these courses, you get 24/7 access for the rest of the time you want to use them as much as you want. I always tell everybody, go ahead and listen to the whole thing at once if you choose to, and then just take 20 or 30 minutes a day and listen to each section and start to internalize it, because it's a lot of information to assimilate in a short amount of time. So listening to it over and over and over again is a huge advantage. And so I always tell everybody, listen to it over and over and over again, and take it slow. Money management, don't rush it. Don't blow yourself out, because that's what most do. They don't understand the money management part, and they lose before they even had a chance. So, take it slow. And I think my time is up, Brett.